All right, so the markets follow a familiar theme today: low volume, no range, no movement. Despite the fact that there's nothing really that we're waiting on. I guess there could be some factors with the debt ceiling, but that's more of a manufactured kind of media thing, political theater. It's not been an issue. It won't be an issue, and most institutional investors know that. So it's not a market problem per se, as say like the Fed's interest rate policies or economic indicators, inflation indicators right now, which have all been looking great. So we can't even really say that we're kind of waiting on something for the market to get going. It's just not going. We can't even say it's like a holiday week, because it's not, and we can't even say it's a summer end of the summer week, which is traditionally a low volatility period when the market doesn't do anything, and it's not that either. So we are really just not going anywhere. But the benefit is, there is some bullish bias to some of these indicators. So I'm going to talk about what those are and why we might be able to burst through, and if we do, how significant that would be. We'll talk about what's driving the price action. It was a pretty risk-on day today when you look under the surface. So we'll talk about how. I'll show you those patterns there. And of course, our trade idea is the stock that we've already been trading in a neutral manner, and it's continuing in that neutral manner. And we'll look at a trade on that as it has earnings coming out through the next expiration cycle, as well as a lot of its peers will be releasing its earnings here this week. So let's go ahead and get started. Today is Friday, May the 15th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of the other things here on the right, including our Market Outlook live video I do at 3:30 Eastern times. Come down to the bottom, click on this heart. It opens up a new tab. You can click that like button there. Also click on this other, the thumbs up icon on the Facebook tab. Once it opens up, it will open up the Facebook tab that you see there. Takes so long for some odd reason, but there's a like button there. Click on that. Again, the more you do that, it helps get our content out to more of our followers on those platforms. That's why we always ask for it day after day. We got 107 likes on the last Market Outlook video here. I did post one for Friday that you can see up here at the top if you click on that. If you didn't catch that, I got it out late, but you can catch that there if you haven't already. But for those who like those, thank you very much. It goes a long way, really helps us out. For those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's take a look at the S&P 500 market forecast, as we always do to start off the video. Again, very small range, smaller than what we've seen. We've had some below average ranges, and now we're even less. It's not the lowest. The smallest range we had was right there, 13 points. And then that was going into the inflation report. And then, of course, now we have a 31-point range. The average is 45, and that average is way down, barely more than 1% at 41. So we're really creeping down on the average range there. The near-term line, momentum line rallied on the gain today. Didn't quite get back above the intermediate line, but they did rally, so they're moving higher. Market sentiment now is in bullish territory, so it has risen up to 60. We are still just barely above the moving average, only 1/3%. So we're really not pushing away. In fact, we're really converging. This move has been just unbelievably so sideways. A couple little moves here and there, but ultimately, outside of those little two moves, really, really sideways. In fact, you can see that here when you look at this chart. Even if I were to zoom out a little bit to like 30 days, so the last 6 weeks. So again, you can see outside of these two moves, this down move there, rebound, and this down move there, and a rebound, we've been that's how sideways we've been. We were pretty sideways going into that. We were pretty sideways coming out of it. Look at even like last week, Friday, and then today is just all inside, inside, inside. And with the point of control right smack dab in the middle of today's range, and Friday's range, and last week's range. And for that matter, close to the middle of the 4-week range. So really, really small moves, and that's that's what you're doing is you're not getting the near term line or the momentum line really able to get going. They've been kind of muted here. We've had some volatility during these moves, up and down. Again, you typically don't get near term line levels that low during bullish intermediate trends. You could argue that this bullish intermediate trend may be over with. The intermediate line is dropping. It hasn't dropped below. Out of bullish territory. It hasn't dropped, especially hasn't dropped below 50 yet or into bearish territory. So it's technically not done, but you could argue it is, considering the light pink shading and the yellow lines, the bull tag, the sideways action that we're only 1/3% above. You can see the here. Let's take a look first before we look at the weekly chart. Let's look at some of the other indicators. The Dow, remember, is no longer in a bearish trend. The intermediate line now has dropped below 50. It has dropped below its moving market sentiment line. That's actually still rising. The near-term line has risen above intermediate, so if it were to really take off tomorrow, then we can change that direction of the intermediate line. But as of right now, it has dropped below, and we're about 1% below. We have been 1% below the moving average. We've had bull tags. We haven't bounced off of them. We're actually continuing lower. So the Dow actually is looking more bearish than, say, like the NASDAQ, which on Thursday got a cluster, and then still came really darn close to a cluster today. And remember, on Thursday, not only did it get a cluster, but even the market sentiment line's above the 75th percentile. So you're that close to all 4 lines producing a cluster, which is not very common, especially when you have indexes like the Russell 2000 and the Dow, as bearish as they are. Now, the Russell did bounce up more today than all the other indexes. Again, you can see its momentum and near-term lines have not really gotten into either reversal zone for the past couple of weeks, aside from this little dip right there. So, I mean, this is about even more sideways, you could argue, than the S&P 500 is, though sideways at the low end of its range instead of at the high end of its range, like the S&P. Now let's take a look at the weekly chart for the S&P 500. And you can see again just how small the weekly range on the Hakiyashi, even the weekly range, like the high and the low shadows are the actual high and lows of the week. The open, remember, is the midpoint of the previous week's body. The close is the average of the open, high, low, and close. So those two are different, but the high and the low are the same as the normal high and low of the week there. So again, we've had 4 weeks in a row of transition candles where we have not been able to really break up above this candle to resume the trend, but we also haven't broken down below it either to reverse it. And you can see, like, look at the size of the candle. It's practically zero. Like, for the last couple of weeks, the size of the body, has been practically nothing, is what you see down here. And the moving average is, you're still actually below the moving average, barely, but you're still below the moving average there. So again, we haven't quite broken down, but we also haven't bounced up yet, and we may be pretty darn close, hopefully, to a bounce up on the S&P. Here's what the 3 green arrows, again, no 3 green arrows. The Qs do. I mean, the Qs have now had 3 green arrows for 6 straight days. None of the other indexes. In fact, the Dow now has had 3 red arrows for 2 days. Unless we get a big breakup tomorrow, we'll have 3 days of 3 red arrows. And you can see the Russell is kind of fluctuating. You got the red arrow on the moving average, but you have a green arrow on the MACD, and you've been fluctuating between red and green on the stochastics. So you're actually pretty close to 3 greens on IWM, but again, we've had that before too and haven't been able to sustain it, and you would expect that would be the case again. But it's the Qs. The stock market right now is the NASDAQ 100, and for that matter, the stock market right now is the NASDAQ 7, the Magnificent 7, the 50% of the NASDAQ 100, 25% of the S&P. They are driving the market. They're only 10% of the Dow, so they got the smallest percentage of the Dow, actually 9.5%. So that's why the Dow is not nearly as bullish as these other 2 indexes are, especially the NASDAQ 100, where it's 50%. Looking at the 2-line version of those 3 green arrow charts, you can see, look how low the MACD is. Like, I drew these lines here to kind of give you an idea. Like, if you were to look across these 2 lines, let me zoom in. If you were to look across these 2 lines, you notice we don't stay inside those 2 lines for very long. Like, And the lines are pretty much where we've been the last few days. So 0.18, 0.16 and a quarter on the top side, and then I just did the reverse of that on the downside. So kind of give a range of a very narrow, because remember this blue line, which is what I'm looking at, measures the gap between the 8 and the 17-day moving average, the green and the red up here. Very, very small gap among, and it generally doesn't stay this small. Generally, we either go up or down through this area, this really, really neutral area. Of course, we're not. And look at the stochastics. Again, it's not common for the stochastics to trade here in neutral territory. So here is, if I were to draw in the actual neutral territory, so between 60 and 60 and 40. I'll draw another one here at 40. And just make it to where it doesn't stand out. So there's your neutral zone. You're going to look across the chart and you notice it doesn't stay in this neutral area. It either goes through it, up or down, maybe comes into it and bounces, like it did there as well, but it doesn't come in and just stay here. And that's what we've done since pretty much April expiration. It's come into it, and aside from a little bounce up, we pretty much stayed in it. This neutral area between 40 and 60 with the volume really kind of coming down. Of course, very significant resistance levels here for the S&P 500, right where we're at right now, where you can kind of see like we hit our head up against it, and then now like the water level is pushing up and pushing us up against the ceiling, and there's not, either it'll push us through, the pressure will push us through, or we just drown, right? We come into the water and we drown, and that appears to be the case. Like we are just going sideways, looking for a breakout move, waiting for a breakout move to occur. And we've had plenty of opportunity for that breakout to occur, with the CPI data looking great, PPI data looking great. I mean, there's a lot of the inflation data, which has made us so bearish, has looked really well. The Fed's widely expected to stop. I mean, they're not. If you look at the FOMC, and the rate hikes is what put a lot of pressure on investor sentiment over the course of the past year. They are widely expected not to raise rates at the next meeting or ever again. In fact, they are more, not in June. June, they still have a 22% chance of raising and a 0% chance of cutting. See, in July, but by July, they actually have a higher probability of cutting than they do of raising, right? So between now and 2 meetings, there's a higher probability of the Fed cutting than raising. And that's all it takes. Not one. They're still, 22 to 0. But in July, it drops down to 14.5 to 26. Of course, in September, so in 3 meetings, because those are both low percentages, in September, you drop down to 6% chance of hikes and a 55% chance of cutting. So it's a much higher probability of cutting by the time we get to December meeting. So, I mean, there should be plenty of macro reasons right now for us to break through this resistance and take off to all-time highs. Earnings came in first quarter much better than expected. I think from what I saw, and again, anecdotally, I just saw this number thrown out there, but I saw that earnings had dropped for the S&P 3% in the first quarter compared to a 7% expected drop. So earnings have come in much better than expected. Inflation looks much better. The Fed's widely expected to stop, and that's been inflation and the Fed has been the two big, causes of bearish sentiment, investor sentiment. They're all gone. All those causes are gone, and yet we can't break through this significant resistance despite all of that. So that's kind of and even with the banking failures, which, at the beginning of the month, they're not even an issue anymore. This was the last, these two little bumps here, the first one especially, were kind of reactions to more banking, and you can see not even close to the same reaction as Silicon Valley Bank failure. So even that's not even an issue. So, there is no reason for us not to break out, and yet we haven't. And that's the concern, again, with this kind of rising water level as to whether or not we'll actually be able to break through the ceiling, or if we end up just drowning without even able to get through, right? Without being able to find the spot to get through there. Let's take a look at, remember the Dow, and And the Russell, like the Dow, is below its 17-day moving average. The MACD is dropping with a negative level, and IWM is also below. Today it did cross back above the 17, but still below the 30 at the point of control. The MACD is above its moving average, but still negative. Of course, it's the Qs that is well above its rising 17-day, close to 52-week highs now, because the August highs are 52-week highs. And you're above a rising moving average on the MACD and easily above zero with the strong stochastics. So big disparities there. Of course, in some of these other oscillators, your DMI, you have a very low ADX. The negative indicators drop below 20 now, with the positive still above 25. So there's a bullish bias there. The RSI and the CCI, you are above zero in the CCI, you are above 50. So again, small bullish bias there too on the RSI and the CCI. Inside the 4-week range, we're still below the average. So not bullish yet, but you can see you will be, assuming we move higher tomorrow, because it seems like the path of least resistance, even the very small moves seem to be to the upside. We should break above that average tomorrow. So again, slight bullish bias there. The hull is obviously showing a bullish bias. It's green. The MACD is above its moving average, even though you don't have any good. I mean, the daily candles are nothing to write home about either. The parabolic stars are still above us, so that's still an issue. The McClellan oscillator is still negative, and that's still an issue, right? The breadth is not there. The McClellan oscillator is still negative. The summation index is still negative. The money flow, when you look at the money flow, it's still below 50. Even though it's rising, it's still below 50. The number of stocks below their 50-day moving average is still below its moving average, still below 250, 50%, and still below its moving average. Same thing with the 200-day moving average. Whoops, that's the 20-day moving average, sorry. Bring this up again. It'd be the 200-day moving average. You can see still easily below its moving average, as well as being below 250. So the breadth is not there, and that's why we can't break through. One of the main reasons why we can't break through there. Looking at the Ichimoku cloud, there's no trend here. There hasn't been a trend on the weekly chart, which is, again, for us to produce a bearish low point, a correction low to touch the 200-week moving average. So in other words, this was a correction. By definition, this was a correction. We filled in the gap between the 50 and 200-week moving averages. That's a correction. Right, breaking the 200-week is a bear market, right? But getting between the 50 and the 200 is a correction. Dropping to the 50 is a pullback. So we have done that, and you can see, 6 months after we hit that 2-week moving average, we should have a bullish trend at least developing. And as you can see, we don't down here. We're not above 1. We're not above 50, or below -1 for that matter. We don't have any kind of trend developing here. So again, it's 6 months off of this low point now, actually going on 7. It's actually 7 months now coming off this low point, and still no trend. And you can see still, inside the cloud, unable to break out, and a very small positive rate of change. Looking at, I showed you this chart here. The range is really, really small. The weekly range we're coiling. We're inside. Everything is inside. The Arun indicator, it's interesting that they were both above 80. They're both on pace to go both down to below 30 unless we really break out of either this high or that low. We're kind of on pace right now to both of these dropping below 30. Whichever one breaks out will be the one that starts the trend in either direction. So that's how kind of close we are. This really, really small trend. You can also see the bands and the Keltner channels. We're getting this is a long period of red dots. We've had a long period of red dots on the weekly chart. This one kind of started with a long period of red dots before we finally kind of broke out there. But we're getting a long period of red dots on the daily chart, on the weekly, on the daily chart too. The bandwidth is really low, has broken below 150-day lows. Like, we are set up for a breakout move. We are not in the lower half of the chart. We're still in the upper half, but we're just not in the upper quartile, which trends, right? Which produces trends. Looking at the today's volume and trading range, you can see that 54 million is really, really low. 3.2 points trading. That's really low. 3.2 is way off the charts. 52 million way off the charts. You know, we're at 1.09% on the ATR, so we're almost below 1. Very, very low. The VIX usually starts the week higher, right? That's the general trend for the VIX. We did start the week higher, but we filled in the gap like we typically do. Interestingly enough, the VIX moved up relative to the VIX 3M, so the VIX 3M dropped even more than the VIX did. And you can see the correlation between the VIX and the VVIX is dropping back below 0 again. So we're setting up, and we dropped, but it's still, you know, the VIX is still pretty close to these pre-expiration lows. The VVIX is well off of the pre-expiration lows. So I mean, again, you can see the correlation is really small. It's well below 50% when you start to worry about, you know, a jump in volatility. And now it's almost back below 0 again, which is typically very rare for this to be negative. Again, if I were to change this so it's easier to see, here, let's do that, and then let's zoom out to the full 5 years. You can see how rare it is to get negative at all, much less stay negative, especially to get to, you know, this 40% level. Very, very rare, and typically coincides with a move higher in volatility, eventually even. And here we go again. Like, we didn't have, like, we've been, like, if I were to zoom out and kind of go long term on this and go like over the course of a full quarter, and we did drop below 0 here, or dropped to 0 on a quarterly basis, and that led to a little bit of a jump in volatility. And now you're dropping almost back below 50% again. So really significant moves on the VVIX, and continues to be. It's not very common for it to be this negatively correlated this often. This is the 4-week correlation. Look, it's rare. 4 weeks, it's rarely below 0, except for here in 2020. 2022, here again in the early part of 2023, and then here just recently, and now we're not able to get back up above here because we're still kind of there. And once this goes back up to 0, again, it typically coincides with both the VVIX and the VIX rising. All right, now let's take a look at what's driving this price action. So let's take a look at the moves to what little move we had. Let's take a look at what's going on today. Again, gold and the Qs are your biggest winners, even with the dollar actually rallying, you know, slightly higher. I mean, it's rallying off of its lows. Real estate, IWM are still your biggest losers over the last 3 months. So you're still got a risk-off pattern here. EFA outperforming EEM. High yield and treasuries are kind of flat against each other right now. So you still got a risk-off pattern going. The S&P flat, about as flat as it can be over that time frame. But just taking a look at just today alone here, you can see EEM had the biggest move today. You also had a move higher, like I said, in commodities and IWM, and bonds with a big move down. So today was a risk-on day, even if the Qs didn't rally, which means the SPY doesn't rally, because, you know, the dollar was down, bonds were down, gold underperformed equities, treasuries way underperformed high yield, and then of course EEM way outpacing EFA. So significant kind of risk-on day. Let's take a look at what that looks like here on some of these charts. Let me go to this chart here. From an emerging market standpoint, which has been underperforming, you can see it's so sideways, and today's move has been great, and so is IWM's. Has been great, but you notice neither one of those moves are trend changing yet in and of themselves. There needs to be a lot more follow through. Commodities, the same thing. Like, it was so relatively oversold considering how flat equities have been. And it had a good move up higher today too, but again, not trend changing. Long-term bonds down today quite a bit, which means the 10-year yield was higher. The 10-year yield made it move back to 3.5%. Of course, breaking above 3.5% would actually be a very good sign until you get closer to 4%, and then obviously that's a reflection of rising inflation expectations. But at least it's right now it needs to kind of stay around 3.5 because the Fed funds at 5.25, so that inversion's what 175 basis points. It's a pretty wide inversion, so it can't go too far. But if it goes up from here, then again, rising inflation expectations only wants that. If it goes down from here, then the economy's kind of cratering. Like it's going to force a rate cut because the markets are in bear market. Equity markets are in bear market, and economic growth expectations are faltering. So it needs to kind of stay here as long as the Fed is staying at 5.25. This kind of needs to stay at 3.5 because you notice any deviation away from it has been relatively bearish for equities. As long as we stay here, we're able to avoid the markets being bearish at this 3.5% mark. But you saw EFA. If I were to take a look here at the major economies, the 12 grid for the major economies, of course, the biggest weighting in FX and EEM is China. So China made a big move higher today, light green shading in the green line. Korea is also a component, as a big factor in emerging markets. India is already dark green shading in the green line. Brazil's got dark green shading in the green line. So your main emerging markets are doing really, really well. Canada's got a link to commodities too, even though it's not technically a emerging market. Like all these others do have the links to commodities and fueling that global economic growth. But you can see, look at Japan. I mean, it's at 3-month highs. It's killing everybody. India, close to 3-month highs, killing it. Brazil at 3-month highs, killing everybody. But France, UK, Italy, Germany, all light pink shading in the yellow line. So they're all there with these bull tags that either, again, we bounce off of or we start declines. So far, we haven't started declines. So it's, after a couple of days, that's a good sign that we haven't continued to the downside yet on either, the Canada included, on either of these. So that's a good sign. But we also haven't taken back off yet either. So, you would hope that EFA follows emerging markets and we rally to the upside. But as of right now, they haven't. So they're still kind of stuck in that position where it can just as easily start a new bearish move as it could to bounce up to a bullish move. And either way, either move it sparks would be a significant move. All right, it would be a move that would either continue the intermediate run to the upside, since it's like pink shading in yellow line, or start a new intermediate decline. Let's take a look at the sectors and how they performed today. Remember, it was a risk-on day from an asset class standpoint, but looking at the sector moves, and you have to keep in mind right now that the XLK and XLY and XLC are considered safety trades. XLK actually did very well. Financials, materials, which are now kind of your risk-on sectors, they did very well. XLC outpacing, XLY underperforming. Utilities, real estate, again, very interest rate sensitive, underperforming. Healthcare staples, also considered safety trades, underperforming too. So, they're not big moves. It's not more than 1%. We continue to get really, really small moves, especially on the S&P 500. We've only had, 2 up days and 2 down days. Really 5 up days and 2 1% down days since we kind of ended that bearish run there in March. So the very, very small historical volatility. So we're not even getting 0.5% moves, much less. In fact, if you go back to the last, this would be 1, 2, 3, 4, 5, 6 days now without a single 0.5% gain or loss on the S&P 500. So we're not getting very big moves. The sector moves are reflecting that, but at least, again, what little move we have, at least it seems to be biased towards risk and seems to be biased towards bullishness that obviously we can't confirm until we break the 4,200 for good and leave it behind us, right? Then we're off, right? If we're hitting 4,400, we're hitting 4,800. We're not going back to 4,000 if we're hitting 4,400. We are taking off at that point, unless, of course, the Fed comes out and says you're all idiots and we're gonna hike rates again because the market shouldn't be rallying, right? And it's kind of what they did in August of 2022. It's doubtful they do that again, but if they did, that'd be like the only thing that could get us from 4,400 back to 4,000. With getting back below this 4,200 level. So if we can get there and leave it behind us, then 4,800, here we come. Again, the problem is we haven't been able to, despite all the reasons we should have, by now, should have been able to. All right, now let's take a look at our trade idea of the day. Let's take a look at Costco. We already have one iron condor on that's about to expire this week, and most likely going to expire at the maximum gain, which has worked out fine, and it continues to work out fine. We do have earnings coming up after May expiration, so going into June. But you can see just how sideways we've continued to be on Costco, and there's been really no reason to suggest it's kind of following or mimicking the market's sideways action. Lots of, very, very small moves here between the 10 and 40 weeks. So your PPO is really small, very small candles on the Hakinyashi candles. So we're not breaking out one way or the other. And if we did break out, then we'd have a clear directional trade considering how sideways we've been for so long. If you take a look here, we're still centered around this in the value area, centered around the point of control. We're still, every week we're trading, all the moving averages are trading within the weekly range. Very small MACD. You take a look at some of these other oscillators that kind of suggest trend strength. This one shows you that there's no strength at all right now. Looking at the RSI and the CCI, they also tell you there's no trend at all right now. We're between 100 and negative 100, or between 60 and 40. You look at the DMI, you look at the DMI, and you see it's showing no trend right now. The ADX is as low as it can be. Both the positive and negative indicators are pretty much between 25 and 20. The negative dipped back below it by the end of the day today, but it was above 20 earlier when we were looking at this trade during the Market Outlook Live. So very small moves. You can see the Bollinger Bands, very small band width relative to the 52-week range. Very at the low end. The bands have been inside the Keltner channels for now going on 2 full expiration cycles. That's what the red dots tell us. So we've been very sideways, and there's been no reason to change yet. Now this week there's a lot of retail earnings. It's not Costco yet, but there will be a lot of retail earnings coming out that could provide a movement. But that's actually going to be, that and its earnings will be built in to the cost of the trade. So if you look at what we've done here, if you look at selling the low 20 deltas on both sides and buying one strike away, so $5 wide, we ended up getting $1.68 on the trade when we put it through in the Market Outlook Live video. But there's our trade, and so you notice I'm getting a normal reward, for my $1,000 of risk that we normally put on these high probability trades. But I'm doing it for 2/3 the normal risk. So it is, the earnings announcement, all these earnings for the retailers this week, the sideways, it's all built into to the risk here. So the nice thing is, if we do break out, I can keep my loss. I have a good chance of keeping my loss much smaller than normal when I have the full $1,000 at risk. And if I end up taking a loss one or the other, then I'll have a really good directional trade going, because that would mean that we're breaking out, and we'll be able to ride that breakout for however long it takes into a new trending move, considering how sideways we've been for so long. So I like the opportunities here for both a sideways trade now, and if it doesn't work out again for a second time, since we're finishing an earlier trade here this week, if it doesn't work out the second time, then it will work out for us and signaling to us a new directional trade that we can jump on the stock that that would be breaking out of these range, or these figures that I've been sharing with you that have told us as of right now to be more neutral on Costco. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.